Good morning, folks. Let's begin because we have an exciting one for you today. What you're looking at is not a tech company. It's not a software as a service company, and it's not a mining company. And it sure as hell isn't whatever garbage is getting SPAC'd out of Dubai this week. This is capital markets warfare running on Bitcoin rails. The blockchain group is actively weaponizing the fiat system's collapse to build a recursive Bitcoin treasury machine. They are engineering a synthetic balance sheet arbitrage protocol inside the carcass of Europe's equity markets, while the ECB is too busy choking on its own negative real yields. You're watching a live experiment in how to financialize Bitcoin exposure faster than regulators can even define it. We are at the birth of Bitcoin native capital formation, where balance sheets don't sell products, they monetize time, volatility, and reflexivity. The blockchain group has entered this arena as one of the most aggressive, unhinged, and brutally efficient players in the entire public markets. This is a story about synthetic Bitcoin acquisition velocity amplified through the recursive compounding of balance sheet torque. If you understand what I'm about to show you, congratulations, you are officially in the 0.1% of people who can actually model the next phase of global capital markets. And if you don't, it's fine. Wall Street Journal will still write a confused article about it in 5 years while you're still in fiat jail. My name is Adam Livingston, and I am your #1 source for Bitcoin and Bitcoin Treasury Company analysis. Please like this video and subscribe to my channel in order to support my work. Leave a comment letting me know what you'd like to hear me comment on next. Here's the core situation. The blockchain group holds 847 BTC. They've got 214.5 million fully diluted shares outstanding. That puts their Bitcoin density at 395 sats per share. On the surface, that sounds small, but you need to forget everything you think you know about per share metrics, because this isn't about static density, it's about stacking velocity. Blockchain Group's current BTC stacking speed is very fast. This is hyper-reflexive capital formation happening in real time. Put simply, Blockchain Group is stacking Bitcoin nearly 50x faster than Strategy when measured against its size. The market cap sits at around 631.5 million euros, with 78 million still sitting in treasury cash, which means they're still sitting on dry powder while the equity markets funds their next round of BTC buys. But the real monster hiding under the bed is the MNAV multiple sitting at 8x. In simple terms, every €1 they raise buys €8 worth of BTC NAV exposure. Their capital formation efficiency is obscenely levered. They're essentially operating a Bitcoin call option printer, fully reflexive, market-fed, and torque amplified. The NAV parity injection zone sits around $150,000 Bitcoin. Once that threshold is breached, the system flips into NAV-driven compounding, where dilution becomes mathematically irrelevant because BTC NAV outruns equity issuance. But, and this is where the management earns their salary, dilution management and liquidity access become life or death. Stay under 2% monthly dilution and the flywheel survives. If they lose access to credits, reflexivity reverses violently. This is the game. This is why 99% of investors simply don't belong in Bitcoin capital markets yet. You're buying access to the bleeding edge of Bitcoin monetization engineering while the rest of the world is still reading Warren Buffett quotes on Facebook. And the beauty is they still have no idea what's happening. Now let's break down exactly what this animal is right now, the company snapshot kill box. The blockchain group currently holds an 847 BTC. That's not the headline number that grabs the attention next to Saylor's 580,000 Bitcoin, but again, that's not the game. The game here is how fast they're stacking and how aggressively they're compounding forward BTC density. They've got 214 million and a half fully diluted shares. That's the cap table they're actively weaponizing to monetize equity premium into BTC. That gives us 395 sats per share right now, or 0.0000395 BTC per share. Normie equity analysts see that number and immediately dismiss it because they think they're still evaluating a normal company. The BTC NAV per share currently sits at 0.43 cents at a 110K Bitcoin spot price. The stock is trading at $325 in US dollars, giving a current MNAV multiple of 8x. This entire structure is basically a capital formation weapon sitting on standby, waiting for the next Bitcoin leg up to ignite another round of hyper-reflexive issuance. The traditional financial world doesn't even have vocabulary for this yet, and that's why it works. Now let's break open the BTC accumulation engine, the absolute core of why the blockchain group is so dangerous. Between March and May 2025, they stacked 227 BTC in 60 days. That's roughly 100 to 120 BTC per month. Let me make that simple. They're stacking Bitcoin faster than any public treasury company on Earth, period. Not Strategy, not Metaplanet, not Semler. This is hyper-velocity stacking. And here's the beauty. The average BTC acquisition cost is around 81.5K per Bitcoin, with spot sitting around 104, 110, wherever it's at today. That means they've already locked in around a 34% unrealized gain on the existing stack before even taking into account how quickly they're adding new coins. Add an 8x MNAV every million they raise creates roughly 8 million of NAV leverage, and the marginal dilution is around 0.11% per 1 million raised. Every capital raise allows them to acquire more BTC NAV than shares being issued. The higher the multiple is holding, the more extreme this leverage becomes. 95% of every dollar raised is immediately redeployed into BTC acquisition. There's no sprawling headcount in this company, no R&D budget, no failed product pivots, no metaverse division bleeding 10 billion a year, just raw capital into BTC conversion, into NAV expansion, into premium compression, into capital window expanding, and then repeating. This is why traditional corporate finance people literally cannot model Bitcoin treasury companies. The equity itself is functioning as a capital formation leverage against recursive Bitcoin NAV expansion. Now we get into the capital structure where the truly sick leverage sits. First, the foundation of this weaponized structure is the 63.6 million euro zero coupon convertible bond struck at 3.81. What does that mean? It means investors literally gave the blockchain group tens of millions of euros with no interest payments in exchange for the option to convert to stock later if things go well. It's basically free capital. Investors are underwriting Bitcoin upside without draining cash flow while the blockchain group stacks. Then we've got their ATM equity raises like the 10 million euro round in May 2025 done at around 110 per share. And then you have the 8x NAV multiple, the marginal dilution, remember 0.11% per 1 million raised. That's almost irrelevant dilution, especially when you're stacking Bitcoin that could double or triple within 24 months. Their BTC dollar equity divided by the BTC dollar value ratio means their equity raises are being immediately leveraged into BTC density at a multiple that would make most hedge fund desks nervous. This is where the real magic happens, the BTC NAV compression dynamics. Let's walk through the reflexivity ladder forward. At 100K BTC, NAV per share sits around 39 cents. At an 8x MNAV, the share price is $3.16. At 150K BTC, the NAV per share hits 59 cents, and the share price equals $4.74. And at 200K BTC, the NAV per share moves to 79 cents, and the share price would equal $6.32. The premium is the capital formation engine itself. The higher the BTC NAV grows, the less premium is required to sustain the model. At 150K BTC, dilution begins to fall behind the NAV growth. By 200K BTC, dilution becomes almost irrelevant. The BTC per share dominates equity issuance entirely. This is called NAV parity compression, where BTC price acceleration naturally eliminates the need for any multiple premium. Reflexivity flips from being equity market dependent to BTC price dependent. If the blockchain group executes properly and Bitcoin keeps doing what Bitcoin does, this becomes a self-funding Bitcoin compounding machine that no longer cares whether capital markets stay open. That's when BTC treasury companies stop being speculative entities and start becoming proto-sovereign reserve balance sheets. Most allocators still have no framework for this. That's why we're here. That's why this is early. If you understand the flywheel, please feel free to skip, but I will continue to explain the flywheel as the education gap in the public persists. The blockchain group opens the ATM, issues equity, but they're doing it at an 8x multiple, meaning every euro raised immediately buys 8 euros worth of Bitcoin NAV exposure. And then they're going to deploy the capital. Unlike regular companies, there's no factories, no employees, no fake software as a service model, no tech bros pitching AI dog food startups. They simply take the cash and buy Bitcoin instantly. This is pure monetary conversion, no operations. The moment the Bitcoin hits the treasury, NAV per share rises. Equity markets instantly begin pricing the future stacking velocity, maintaining the premium. And then as BTC price rises, less equity premium is needed, Capital formation actually becomes cheaper over time as NAV per share outruns share dilution. And then you repeat it at higher altitude. With each turn of the flywheel, BTC capital formation becomes more efficient. BTC per share density increases. The equity curve steepens non-linearly. This system works beautifully until capital markets freeze, which is why they need BTC repo lines as the backstop for risk-off liquidity. If you manage dilution carefully and keep the flywheel spinning while BTC price rises, you create a recursive balance sheet monster that no bank, sovereign, or family office knows how to model. Here's a quick reminder on the price bands. Now, most allocators stop here. They see the NAV multiples and think, why would anybody pay 8 times NAV? That's not value investing, they shriek. And that's why most of them are still trapped in the 1970s. Once you cross the 150K BTC, you enter what I call the NAV dominance zone. This is where the BTC NAV per share expansion begins outrunning the equity dilution curve entirely. This is the parity compression. The multiple naturally compresses because BTC is doing the work. Equity issuance becomes less critical for the NAV growth. And this is the real reason BTC treasury companies will outperform spot Bitcoin by a lot in certain market windows. You're buying acquisition velocity. Capitalize that recursive torque. Now, let's be very clear, this is not risk-free. Anyone telling you that Bitcoin treasury companies can't blow themselves up does not understand how reflexive capital structures work. The blockchain group is sitting on what I would classify as a BB BTC credit rating. The net to debt BTC remains comfortably under 1x, no coupon obligations today. All debt is embedded optionality via converts. This is optimal capital torque for now, but it requires constant discipline. Their volatility adjusted BTC exposure sits at 2.2x equity. Let's stress test this thing. Assume Bitcoin cuts in half, a 50% drawdown down to 55,000 BTC. NAV per share collapses to 0.20 cents. The MNAV multiple expands to 14.5x. What happens here? The reflexive flywheel doesn't break immediately, but it does stall. Equity raises become massively more dilutive, capital access narrows, and repo credit lines become the lifeboat. This is exactly why BTC repo facilities must be established in advance. The entire game is pre-positioning credit support before risk-off liquidity events hit. Because once volatility spikes, repo markets seize and equity markets panic. But structurally, this is still less dangerous than traditional high-yield junk credit, because Bitcoin itself remains the underlying collateral. And more importantly, their converts remain non-cash burning. They don't owe coupon payments. The equity simply reprices as NAV rebuilds. This is reflexive capital structure engineering. Both directions must be respected. Most CFOs are not smart enough or honest enough to talk about this part. Now let's model out where this flywheel takes them, depending entirely on execution discipline and capital access. 3 scenarios by December 2026, with a conservative case of 60 BTC added monthly, 1,927 BTC stacked by 2026 year-end, fully diluted shares rise to 260 million, BTC per share goes to 7.41 millionths of a Bitcoin per share. The base case, which we can call the current trajectory, means 100 BTC is added per month, roughly today's pace, 2,647 BTC on the balance sheet, 300 million fully diluted shares outstanding, and that leads us to 8.82 millionths BTC per share. And then this is the aggressive case, 150 BTC stacked per month, which is fully engaged reflexivity. That would lead us to 3,547 BTC on the balance sheet, 350 million fully diluted shares, and 1.01 millionths BTC per share. Now, I want to emphasize, these BTC share numbers do look small. This is where the normie brain breaks completely. The game here isn't static BTC per share, it is BTC density compounding velocity, recursive equity to BTC NAV leverage, and the absolute torque this creates as Bitcoin price rises. If BTC breaks 150 or 200K while this flywheel is intact, the BTC NAV density accelerates far faster than share dilution can keep up. This is why every allocator that's still trying to run discounted cash flow models on these businesses is operating 10 years behind reality. Now we step out of the linear world and enter the realm where very few people can model these companies properly, stochastic volatility modeling, full Monte Carlo pathing. This isn't hypothetical, this is simply how non-linear recursive capital structures behave under wide BTC volatility bands. We ran 1,000 price paths out to the end of 2026 using 60% BTC volatility, which is low by historical standards, and 80% equity volatility, which captures the reflexive torque from equity issuance plus NAV expansion. The 90% confidence interval delivers BTC per share between 35 cents and $2.80 at a constant 8x MNAV, and it could go higher, but that's a share price range of roughly $2.80 to $22.40. But that's not where it gets interesting. The tail risk is where you make your money. If BTC drives through 240K, you easily cross $3.10 NAV per share, with share prices pushing above $24.80 at the same multiple. The longer the equity window stays open during BTC price appreciation, the more extreme the NAV curve becomes, until the system reaches self-funding hyper-reflexive escape velocity. And that's where these companies turn into Bitcoin native reserve banks. Yes, I used the B word. Now let's anchor the blockchain group inside the broader Bitcoin treasury universe, because this is where you see why reflexivity is greater than density in early stage BTC treasury companies. First, absolute BTC holdings. The blockchain group, remember, has 847. Strategy has 580,000. Metaplanet has 8,888. And Semler has 4,264. No question, Strategy remains the apex predator in raw Bitcoin tonnage. But raw BTC isn't the game here. Stacking velocity is the game. The blockchain group's BTC yield sits at 860% annualized, the highest in the entire public market. This is pure capital formation torque. BTC per share density, the blockchain group has 0.039 BTC per 10,000 shares. Strategy has 3.61 BTC per 10,000 shares. Now you see the runway of blockchain group and how amazing this could mean for share price growth. This lower BTC density at the blockchain group is precisely why the capital formation window is still wide open. The market is paying for future BTC capture velocity, not static BTC on the balance sheet. These MNAV multiples are not random. They reflect where each company sits on its capital formation curve. The early high premium reflexive growth zone is the blockchain group. The mature NAV parity compression is where Strategy is sitting, and the mid-reflexive monetization window is where Metaplanet and Semler are sitting. The risk is mismanaging dilution, but the reward is fully capturing recursive Bitcoin monetization velocity before the window closes. So let's make this very simple. The blockchain group is a synthetic recursive Bitcoin balance sheet weapon, sitting inside a publicly traded European wrapper while the rest of global finance is still crying about Jerome Powell's next speech. This is hard balance sheet warfare using the collapse of fiat as its core energy source. If they stay disciplined while Bitcoin crosses 150,000 and 200,000, the flywheel flips, NAV compression dominates, equity dilution becomes irrelevant, and the entire capital structure self-funds off BTC price acceleration. At that point, the blockchain group becomes the Bitcoin native Eurozone reserve asset issuer, able to issue BTC-backed Eurobonds into the global credit markets while sovereign states run 150% debt to GDP and beg for IMF bailouts. This is the future of balance sheet monetization in a coinized financial system. The reason why this amazing opportunity still exists for you all is because 99% of allocators, family offices, pension funds, are still running valuation models built for 1987. They don't understand recursive capital formation. They don't model reflexive balance sheet torque, and they still think cash flow models apply to Bitcoin native capital engines. And that's fine because that's where our alpha comes from. By the time capital allocators figure this out, the NAV already moved 10 times higher. This engine structure, when properly executed, is going to become the most asymmetric capital formation engine of the 2020s. We are simply front-running the last 30 years of institutional misunderstanding. While the world slides into a sovereign debt implosion, while fiat burns, and while Bitcoin absorbs every broken financial instrument ever created, the blockchain group is building a recursive Bitcoin treasury protocol while everyone else is still running spreadsheets. And right now, you are extremely early. One more quick note. I saw Alexander, the man in charge, speak multiple times at Bitcoin 2025. And he is a prim and proper and eloquent French gentleman. When you hear him speak with an accent that sounds like Bitcoin per share, you can't help but acknowledge his immediate credibility. I could not be more bullish on this stock. But remember, this is not financial advice, this is financial entertainment. My name is Adam Livingston, and I hope you enjoyed this presentation. May the Lord bless your soul. Have a fantastic day.